We've got a really important topic on our minds today, and this discussion on the triple lock state pension tax implications here in the UK, it's been arranged by ProTax Accountant, a very well-known accounting firm.
Yes, absolutely. And it's timely too, because for this coming tax year, 2025-26, we're seeing a pretty significant 4.1% increase in the state pension.
Right, the triple lock kicking in again.
Exactly. It's that mechanism, isn't it? Pension goes up by whatever's highest,
Yeah.
inflation, average earnings, or 2.5%. And this time, it's the earnings growth figure that's driving it.
So, okay, a bigger state pension sounds good on the surface, but what we really want to get into is there a catch here? How does this increase actually affect pensioners' wallets when you throw our current tax rules into the mix?
That's the key question, really. The crucial thing to remember is the personal allowance for income tax. The amount you can earn before tax starts.
Yeah, the 12,570 pounds.
Precisely. It's frozen at 12,570 pounds, and it's stuck there until 2028. Now, with this latest increase from April 2025, the full new state pension is going up to 230.25 a week.
Which works out to.
That adds up to 11,973.5 a year. And for those on the older basic state pension, that's 176.45 weekly or 9,175 annually.
Okay.
What's really striking is just how close that 11,973 figure is getting to the 12,570 pound tax threshold.
Wow, yeah. So someone on the full new state pension, they're only, 597 pounds below the threshold? That feels incredibly close.
It is. It's a very narrow gap, and it feels like this triple lock benefit could sort of inadvertently push quite a lot of people into paying income tax for the first time.
Right.
That's exactly it. This whole situation really highlights what economists call fiscal drag. You see, when things like pensions and wages go up, but the tax thresholds stay put.
More people get pulled into the tax net.
Exactly. They get dragged over the threshold. And the current estimate is something like 300,000 extra pensioners could find themselves paying income tax in 2025-26 because of this.
Yeah.
People who maybe haven't paid it before.
300,000. That's a huge number. It really puts it into perspective. It's not just existing taxpayers paying a bit more. It's potentially a whole new group.
It is a new financial reality for many.
So with things being that tight, how much difference does just a little bit of extra income make, on top of the state pension?
Even a pretty small amount can make all the difference. It can be the thing that tips someone over that 12,570 pound threshold. So let's imagine someone gets the full new state pension, the 11,973.
Okay.
And maybe they also have a small private pension, perhaps bringing in just £1,000 a year.
Right. Fairly modest.
Yeah. But their total income then becomes 12,973. And suddenly, that extra 400, 300 heirs over the threshold is taxable. That could mean an unexpected tax bill they weren't planning for.
And that's just from a small private pension before you even think about maybe some part-time work or savings interest. Actually, we heard about a case, Marjorie from Huddersfield. That seemed to really illustrate this point.
Yes, Marjorie's situation is quite telling. She receives the full new state pension, and she also has a private pension of £2,000 a year.
Okay.
Now, the state pension increase pushed her total income just over that tax threshold. So she's facing a higher tax bill than she expected. But what makes it particularly tough for Marjorie?
There's more.
Yeah, she's also lost her winter fuel payment because her income tipped over the limit for that too. So you see, the state pension went up, but the combination of higher tax and losing another benefit means she actually feels worse off.
Gosh, that shows how complex it can be. It's not just one single factor.
Not at all. These things interact.
So it's clearly vital for pensioners themselves to be aware. But what about those who are still working past state pension age, pensioner employees, I suppose? How does this affect them?
That's another important group, yes. And maybe something for business owners to think about too. That state pension increase, because it's taxable income, can actually reduce their pensioner employees' take-home pay.
Because their total taxable income goes up.
Exactly. They might end up owing more tax through PAYE. So it's probably a good idea for both employers and these employees to, double-check their tax codes, make sure the right amount of tax is being deducted.
Is there a standard code people should look out for?
Well, the standard personal allowance code is 1257LL. That's the one most people will be on if things are straightforward.
And where's the easiest place for people to check that code?
The best bet is probably through their personal tax account on the HMRC website. It's definitely worth doing.
Why is that?
Because incorrect tax codes can happen. Sometimes people end up on an emergency tax code for a bit, which often means they overpay tax initially. HMRC actually issues quite a lot of tax refunds each year because of these sorts of errors.
Right, worth checking then. So, okay, you can't defer the state pension once you've claimed it to avoid this. Are there any other things people could look at, any strategies to maybe lessen the tax impact?
Well, there are a few possibilities, but it really depends on individual circumstances.
Mm,
If someone has other income sources they have some control over, maybe timing when they receive that income could potentially help, though that's often tricky.
okay.
More realistically, it's about making sure you're using all the allowances you're entitled to. For example, there's the marriage allowance.
How does that work again?
If one partner in a marriage or civil partnership isn't using all of their 12,570 pounds personal allowance, they can transfer 12,260 pounds of it to their higher earning partner, assuming they're a basic rate taxpayer. That can reduce their tax bill.
Ah, okay. Anything else?
There's also the blind person's allowance, which gives an additional tax-free amount for those eligible.
Yeah.
It's about knowing what's out there.
And what about savings? Do they play into this tax picture at all?
Yes, potentially. There's something called the starting rate for savings. If your income from other sources like pensions or work is below a certain level, currently 17,570 pounds,
Right.
then some or all of your savings interest might be tax-free, up to a limit. For someone whose only income is the state pension and it's below that 17,570 pounds, they might get up to 1,000 pounds of savings interest tax-free using this starting rate, on top of the regular personal savings allowance.
I see.
And of course, we shouldn't forget pension credit. That's vital support for low-income pensioners. It tops up weekly income and has its own thresholds. Definitely worth checking eligibility if income is low.
Okay. Looking sort of bigger picture now, are there any longer term things people should bear in mind around the triple lock-in tax?
Well, for those who haven't claimed their state pension yet, deferring it is still an option. If you delay taking it, you get a higher weekly amount when you eventually do claim.
Hmm.
It's a personal choice, obviously. And thinking about savings generally, using individual savings accounts ISAs is always a good strategy. Any interest, dividends, or capital gains within an ISA are tax-free.
Always useful.
Definitely. And finally, just worth remembering that the triple lock itself, well, there's always ongoing debate about whether it's affordable in the long run, so future governments might look at reforming how pensions increase. It's not set in stone forever.
So, wrapping this up, the main message seems to be yes, the state pension increase from the triple lock is helpful, but because those tax thresholds are frozen, quite a few pensioners could face unexpected tax bills, maybe for the first time,
That's the crux of it, yes.
which really underlines how important it is to kind of understand your own tax position and definitely check that your tax code looks right.
Absolutely. Being proactive is really key here. Don't wait for a surprise bill.
And if someone listening wants, personalized advice, wants someone to look at their specific numbers and how these triple lock tax implications affect them, who should they turn to?
For that kind of tailored expert guidance, we'd strongly recommend reaching out to ProTax Accountant. Their team really knows this area inside out and can give the specific advice people need.
Right. Getting in touch with ProTax Accountant sounds like a very sensible step to understand your own situation and make sure you're prepared. It really is all about planning ahead, isn't it? Especially for retirement. Thank you so much for clarifying all that today.
My pleasure.